In this week's Property Insider video, Dr. Andrew Wilson and I discuss our changing property markets. There's currently a downward trend in auction clearance rates and also a downward trend in home loan approvals. What's the feeling out there? How are buyers and vendors feeling? What does it mean? What's ahead? We also talk about the latest GDP figures and home loan approvals and Dr. Andrew Wilson's latest rental market report. Lots to discuss, so if you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you informed each time a new show comes out. The downward trend in auction clearance rates continued this weekend, despite fewer properties being put under the hammer. Decreasing affordability in our two big capital cities, a significant rise in fixed mortgage rates, rising variable rates, uncertainty about inflation, and a media full of stories of real estate Armageddon seems to have dampened buyer enthusiasm. And vendors are also getting a bit concerned at the moment, selling their properties before auction or withdrawing their properties from auction. There's also some insights into what's ahead for our property markets in the latest home loan data. And that's what I want to discuss today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, as well as the latest GDP figures. Hi, Andrew.
Yes, hello, Michael. It has been a busy week for Property Insight. We are into winter now, so happy winter to everybody. And it is traditionally the quieter part of the year for real estate, for property. Perhaps the winter selling season and the chill in the property markets has come a little bit earlier this year. And we shouldn't be really surprised about that because of all the, I guess we could say, white noise that's floating around the markets at the moment.
Well, while the housing markets and house prices are floundering at the moment, the rental markets are going gangbusters. Well, it is if you're an investor, but not if you're a tenant. The market shortage seems to have worsened over May, Andrew.
Yeah, no positive news for tenants over May, Michael. Vacancy rates continue to tighten. Rents continue to rise, and rise is probably a moderate word. They're skyrocketing at the moment. It is a very tough market for tenants. Even those sub-markets, the Melbourne CBD unit market and some of those inner suburban Sydney unit markets, vacancy rates are falling quite sharply there now, and available properties are being soaked up quite quickly. And we're also seeing rents rising in those areas for units. And of course, they are coming from a lower base, but nonetheless, they're the only, or were the only bright spots for tenants looking for more supply than demand. But now that's even starting to reveal a complete market where we certainly have a shortage of rental properties, and really no sign in sight that we'll see any relief to a shortage of rental properties and higher rents. So good news for landlords, not so good news for tenants, Michael.
Well, it's really related to supply and demand, and with vacancy rates so low, rents are going up. The demand is increasing because the borders are open, the airports are busier, students are back, expats are returning, people are coming to Australia. Now, normally the demand would also be filled by lots of new apartments, but from what I'm hearing, a lot of the new apartment towers that were on the drawing board aren't going ahead, related to higher building costs, difficulties getting builders, uncertainty about completions, Andrew.
Yeah, well, everywhere you look, Michael, it's a story of too much demand and not enough supply. And going forward, there's really no potential to ease that imbalance. We've got borders open again. That means migrants, that means international students. Of course, international students are particular drivers of demand in inner city apartment markets. We still have very low building levels. Apartment approvals are down by nearly 50% compared to 4 or 5 years ago. Part of that overreach in terms of supply through COVID in the inner city apartment markets was because the Airbnb landlords were shifting to permanence. Now, Airbnb is now back into holiday accommodation generally because there is significant demand there. It's getting a lot tougher to get an Airbnb property in Melbourne and Sydney. And of course, those rents are rising as well, reflecting again open borders and higher demand. And as you said, Michael, that'll only increase. So that means that what was available as permanent, that were Airbnb, has now gone back to Airbnb, which means even fewer choices for tenants. And it is almost a perfect storm of demand over supply, not just now, but into the future. And
there's no short-term solutions as far as I can see. And because cost of living is going up, because it's harder to save a deposit, or because house prices have gone up as well, you can see that a lot of first home buyers are not going to be able to get into the market like they were hoping to. We've brought forward a bit of first home buyer demand with those grants over the COVID period. I guess that means there's going to be more tenants looking for accommodation, not moving into the first home buyer market.
Yeah, that's right, Michael. And I think the other point is also about affordable choices. And as vacancy rates for houses are at near record lows, factors of COVID, work from home, has driven that to some degree, perhaps a little overstated, but nonetheless, with those very high rents for houses, particularly in Melbourne and Sydney, tenants will be looking for more affordable choices, and that means apartments, and it is all part of that irresistible drive to apartment living, particularly in Sydney, but also in the other major capitals of Melbourne and Brisbane. So as I said, it's quite a bleak outlook for tenants, and they should expect, unfortunately, to be paying more and more for rent. And in an environment where inflation is at 20, 30-year highs, that's just another burden to carry.
Now, there's been lots of news over the last week, and the economic data, the latest economic data from ABS, revealed our GDP. But it depends who you listen to. Some people said, gee, our economy is doing well. But the way I looked at it, it was an underwhelming result.
Well, that's right, Michael. We grew by just 0.8%, and that was really back to where we were basically before COVID. And we had a very strong result over the December quarter, but of course that was a rebound from lockdowns. But the numbers I thought were quite underwhelming, and back to where, as I said, we were at the sort of numbers we were getting before COVID. And that, of course, was in a period where the Reserve Bank was cutting interest rates because they were concerned about the underperformance of the Australian economy. I'm talking back in 2019. And even the other data was underwhelming and perhaps at the margin a little bit disturbing. The savings ratio fell quite sharply again, Michael, to the lowest that we've had during the COVID period, just over 11%. Still, a reasonably high number, but it has been falling sharply over recent quarters from a record level. But nonetheless, perhaps it indicates that consumers are starting to eke into those savings that were put away during COVID. And we shouldn't be surprised about that because of high prices. Also, compensation for employees actually fell over the quarter compared to the previous quarter. And that would have been another measure the Reserve Bank would have been looking for to substantiate their predictions of strong wages growth into the future. So that would have been another disappointment for the Reserve Bank, along with the disappointing wage index data. So I'm not sure we'd be high-fiving over that GDP data, Michael, particularly given, we're in an environment now where the Reserve Bank is putting its foot on the brake pedal.
Other data that came out during the week was the home loans data. And I find that interesting because that's a leading indicator of what's ahead. People get their home loans in advance or apply for them if they're feeling confident, if they're looking forward to buying their new home or their investment property. And home loan data fell over the April period, Andrew.
Yeah, it was quite a sharp decline, Michael, and this is seasonally adjusted data. So it should account for factors such as holidays, which April, of course, had a significant holiday period. We had Anzac Day and Easter adjacent. Of course, we had the commencement of the election campaign and a lot of speculation about interest rates going to increase. So I think that there's a little bit of that confidence factor there. The fear factor is now clearly moving into our markets, and we expect that in the shorter term with increases in rates. And we know affordability has been pushing down home lending activity, and that, of course, is eminently logical because higher house prices mean you have to borrow more, and eventually you run out of the income to be able to push prices up, and that takes you away from the home loan market. But positives going forward is we'll certainly see more first home buyers in the second half of the year taking advantage of those policies, and investors still have a reasonable appetite for property, particularly given skyrocketing rents at the moment where yields are still holding despite some weakness in prices.
I think, on the other hand, some people are wondering, well, how high are rates going to go? Will all those unfavourable property predictions eventuate?
Yes.
And that puts some people sitting on the sidelines. What we've found in the past is those sitting on the sidelines are going to miss some great opportunities, aren't they?
Well, that's right. And look, this is deja vu all over again, Michael, because we went through exactly the same thing 2018-19, and we had a lot of negative press, a lot of negative factors. The Royal Commission into the banking sector. We had the election, which had the prospect of changing the tax mix for investors, and a raft of ridiculous predictions of house price crashes at that stage. But the point is that buyers started to move into the market quite early, even before we had those interest rate increases at the back end of 2019. And by early, I mean early in 2019, because fear factor, which drives markets in the short term, doesn't really affect the essential supply and demand factors. It just means buyers and sellers sit on the sidelines until they start feeling a little bit more confident about the market. And the similar scenario, I believe, will occur in our markets now. Of course, it's exacerbated by the winter selling season, which is typically quieter anyway. But I think that we will get our usual spring revival, because a lot of that negativity will have worked its way through the system. But the fear factor in the short term is a significant influence, Michael, on activity, but all it does is postpone those inevitable decisions about getting a bigger home or a smaller home, or moving to the beach or the bush, whatever it is. And those things will still occur once confidence is stabilised.
Right. People are still going to get married, get divorced, have babies, or maybe not in that order. But life is going to go on, isn't it? So people are going to move home. Now, each week we talk about the auction results because they give us a good indication of what's really happening on the ground. And this weekend, the downtrend in auction clearance rates continued, Andrew, despite fewer properties being put under the hammer.
And I think that validates what we've just been discussing, Michael. I think the winter selling season has come early, even though we're technically in winter. We usually see the cooling of the market start towards the end of June. Of course, we have the Queen's Birthday long weekend next weekend in most jurisdictions. And typically we see a surge in activity prior to that long weekend. It didn't happen this year. We had a bit of a surge the weekend before, but of course that was after the pause for the national election, the general election. But numbers were quite low, surprisingly low, in Melbourne and Sydney particularly. And you've got to understand that these decisions by vendors were made around about a month or 6 weeks ago, Michael. And of course, that coincides with the heightened speculation about an increase in rates. So I think that we're seeing an early cooling of the market, not just from those seasonal impacts, but also that fear factor that we were discussing, that buyers and sellers are starting to think, well, we'll sit on the sidelines and perhaps wait till later in the year to become active in the market. But clearance rates in Sydney were the lowest since May 2020, which of course was the most severe part of the lockdown. We go back to a normalised market or a normal market, clearance rates were actually back to where they were at the same time 3 years ago. Certainly a balanced market now between buyers and sellers, but we are moving into that in Sydney, that winter period. And in Melbourne, a similar result. Clearance rates were down also to a equal this year so far low. And numbers were also quite low in that Melbourne market, Michael. Adelaide continues to be the top performer, and they actually bucked the trend and had another big day of auctions in Adelaide. And the price data that we revealed for May showed that Adelaide is the number one performer for house prices as well. So that's validating that. Canberra, as with Sydney and Melbourne, has come back to the pack as that market has cooled. And again, it's also about affordability and buyers that have waited to be part of the market during COVID. A lot of that pent-up demand has been satisfied as well. I'd take that Brisbane result again with a grain of salt, a significantly higher result in Brisbane. But what we did, a number of auctions were actually agents hadn't reported the actual, even though they reported the result, it was not to be disclosed, the details. And My Housing Market only deals with auctions that are actually disclosed. And so that meant that obviously some signs there in Brisbane as well that results aren't where they were recently. So it is the beginning of the winter selling season, Michael. We do expect a quieter period until the spring revival. It's come a little bit earlier because of cyclical factors such as higher interest rates and the end of the boom, but a revival will likely come as usual in a couple of months' time.
Well, we've already discussed how buyers are being a little bit more cautious at the moment, but these results also seem to suggest vendors are losing confidence. Lots of properties are being sold before auction. In other words, vendors are less willing to test the marketplace under true auction conditions, and quite a number of properties were withdrawn this weekend, Andrew.
Well, again, it's that confidence factor, the fear factor, and no surprise given the confluence of the end of the strong boom cycle, higher interest rates, and the commencement of the winter selling season, Michael. Winter can actually be a positive time for buyers moving into the market because we have a much higher proportion of non-discretionary sellers coming in, those that unfortunately have to sell for whatever reason, divorce, death, moving interstate, whatever it may be. And that can mean that the buyer has a bit more of an upper hand in the negotiation process. So, but look, as usual, spring revival will occur from this year, a lower base, but we're sort of normalising our market in the sense that we've come through the COVID period. It's just a question of the outcome for interest rates and how confidence recovers in the shorter term from what is naturally a sort of a trepidation from buyers and sellers early days when we're moving into this new cycle.
You're right, it has a lot to do with confidence, and unfortunately it can be a self-fulfilling prophecy. If everybody feels confident, the market booms, and if people feel unconfident, the market falters. Unfortunately, most people got it the wrong way around. They feel least confident when they should actually take advantage of market conditions like this, and they feel most confident when all the news is positive near the boom times, Andrew.
And that's what we saw in 2019, Michael. We had a terrible period where the fear factor infected markets, those predictions of 40% falls in house prices, which were just ludicrous, and others were largely taken on board. But all it meant was that buying and selling decisions were postponed. And it was interesting that we did see, even before those factors were, I guess, dismissed, that buyers had started to move into the market. So savvy buyers do that, of course, Michael. They realise that affordability is improving. And as we discussed with the rent report, there's a clear indication there that we're undersupplied for property anyway, and that we're going to continue to head with demand over supply, and people have to live somewhere, Michael.
And as long as there aren't too many forced sellers, and there's no reason why there should be, there will be an underpinning of property values. Look forward to catching up with you again next week and seeing what other news we have.
Yes, thank you, Michael.